The broadcast is now starting. All attendees are in listen-only mode.
Hi, everyone. Welcome. I'm Megan Cox, the Marketing Events Manager here at Curinos, and I'm excited you're joining us for today's webinar, Expanding into New Markets, Strategies for Growth and Optimization. We've got two great hosts with us today, Andrew Hovett, Managing Director at Curinos, and Ben Hopper, Managing Director of Retail Strategy at Adrenaline. At Curinos, we're all about helping financial institutions grow smarter with the right data, tools, and insights to attract, retain, and grow more profitable customer relationships. If you have questions during the session, drop them into the question box in your GoToWebinar control panel. We'll be monitoring those. And yes, we are recording this. You'll get the full recording and the presentation deck in your inbox no later than tomorrow. All right, Ben, over to you.
Hey, thanks. Thanks, Megan, and welcome everyone. Great to be here again today. And it's interesting, the strategies for growth and optimization. And Andrew, we talked about this a little bit. Optimization these days feels like it's less about reducing, it's less about survival of a channel and more about growth. And I think that's pretty neat, kind of what we've seen over the last 18 months. Today,
that's definitely a big shift. Yeah, definitely a big shift and exciting.
Yeah. So today we've got an action-packed agenda, pretty simplified for you. Look at the basis. Branches are back, baby, and I think we're gonna unpack why and what we're seeing in the industry. And then the next couple of sections are just some frameworks and some ways to think about your network planning process. You know, a lot of the times this time of year, network planning comes into focus, and so a couple of frameworks, a couple of toolkits that will help you through that process. So branches are back. Andrew, let's just jump right in. I get the news slide here to show off. Look, it's been about 18 months now since Chase jumped into this branch race of, hey, we're investing in branches, and the big national banks all the way through regional, kind of down into community, has followed suit, and we've kind of a smattering of what you've seen in the news cycle lately, but the bottom line is branch investment is kind of back in vogue, and controlling that investment very intentionally is certainly necessary. Andrew, what else you got? What else you saying for us?
Well, definitely. I mean, I think it's after 5+ years, probably more than that, but of net closures throughout the industry. Right, we're seeing, and that was really, as you said earlier, Ben, it was like straight closures, right? There was a few builds happening, but mostly closures, and we depending upon the segment of the industry, super regionals were down, 20% of their branches over a 5-year period. Regionals and community banks a little less aggressive on the closures, just because they have, frankly, fewer branches to start with. But we've definitely seen a rebound now with announcements for investment in branches. This page doesn't even include Truist's announcement from last week, where they're joining the party as well. So pretty exciting, and kind of harkens back to the mid-2000s when there was a lot of branch building going on, and for folks who are practitioners in network planning like Ben and myself, it's much more fun to have a mix of consolidations as well as openings, so that you're not only looking through one side of the lens. And I think Ben, you also hit this right earlier around optimization. There are still closures to be made out there, but they're being balanced by how do I find some closures to help fund the investments elsewhere, right? If we think about one of the challenges of closing branches over the last 5 years is it's meant fewer kind of front doors for new customers to come join the institution. And I think there was a hope and a belief that as we reduced our branch presence, right, and that more of our sales would be coming through the digital channel. And then what you do see on the left is we have had a net increase in the percentage of new relationships coming in for the digital channel, right? So there has been a little bit of a channel shift here. The however is the quality of those relationships, whether looked at through the lens of average balances or looked through the lens of retention, are abysmal relative to the branch, right? And we do believe that over time that gap will slowly converge. But in the near term, banks are really challenged because this trade hasn't quite worked out for them, with fewer branches bringing in fewer customers, and digital not necessarily picking up the slack. And the result of this is most banks and credit unions are challenged to actually be driving net customer growth, right? So I have fewer front doors for new customers or new members to come through. I've got this shift to digital, but many of those relationships are not sticking. And therefore, on an industry-wide basis, we're looking at, less than 1% kind of net checking customer growth. Higher performance still doing okay, but if you looked at historical perspective on this, where the top performers were probably running at 4 and 5%, that's definitely muted relative to that. And I'm sure many of you have in your plans headier growth rates than what are on this page. And so, what that's really what that's forcing banks to really confront is, I need to be able to access new pools for customer growth. And one of the ways I'm going to be able to do that is through establishing new branches. And that can be outright new branches going into new markets where I don't currently have a presence, or it can be within markets where I have a presence. How do I tap into perhaps submarkets or parts of the market that I'm not currently covering? But I've got to balance that, right? I've got this investment agenda around building new branches, or doing relocations, or even refurbishment where I've perhaps neglected the network for a while. But I've got to continue to find opportunities to fund this. No one's going to give the head of retail a free check to just go build, willy-nilly. So we've got to figure out, how do I find savings remaining within my market in order to shift it over to that investment agenda. I think the one last thing I would say on this is, as excited and as bullish I am around kind of investments in the network, is a big however around de novo branching, right? If you look at the chart on the left, other than frankly Chase, who's really kind of figured it out, they've got a machine going now, right, where they're building branches in markets where they previously did not have presence, or extending their branch presence in some of those new markets. Most regional and super regional banks are struggling to get the kind of growth that they might have had within their performance, right? So if you look at the lines on the left, two things. One, the growth rates are a little lower than peers, but also you're seeing flattening, right? So if a branch is flattening out after 7-8 years from a growth perspective, it's pretty much tapped, right? So it's gonna, from there out, it maybe gonna be able to ride the curve of kind of average market growth. But it's already kind of proved itself out. It's fully baked. Whereas I think obviously you see the national event branches are actually continue that growth trajectory. So one, kind of the average, if you will, for all of my new de novo investments is plateauing. And then what you see on the right-hand chart is massive variability, right? So I'm building locations, and this is for an example bank. I'm not going to name the bank, but what you see is their mix of de novo investments. Some of them are growing to be really tremendous locations, but others are really stuck on a pretty low trajectory, right? And so the challenge to the industry is, one, how do I steepen the curve, that growth curve, and get a curve that looks more like a national bank? But also, two, how do I narrow the variability that I'm experiencing on the right-hand side, such that not every new de novo is a coin flip, but hopefully some of them have the right trajectory to be able to achieve breakout growth.
Perfect. So branches are back. Branches are important, and really strong network distribution planning is necessary. And so you kind of opened up with, we're going to give some frameworks to think about network planning. And this is a framework that I've used for many years to think about like the different components of network planning and branch design. And oftentimes I have seen, Andrew as well, is that, look, there's gaps here. that where different components aren't crossing paths with each other, and that is either a siloed type of organization or maybe just the realization that that these gaps, are present. I will also say this is kind of represented as a linear approach to network design or network planning, and that's not necessarily true. These things all have to be both intertwined and connected. But when analytics, market data is not connected to strategy for whatever reason, either we're not understanding what the market data is telling us, or we're not believing what the market data might tell us. There's a gap there that leads to some disconnected decisions in the strategy kind of realm. When those things happen, strategy then it gets disconnected from design. Your strategic intent in a branch design, if it's not, well, let me back up. If you're not creating an experience and then building a branch around that experience, all you're talking about in branch design is aesthetics and colors, which is not necessarily the intent that that strategy lays out. All that to be said, and when you get to execution, your branch managers and your branch leadership get up every morning just to be good at what they do. And if the execution, the performance that you're expecting from them is disconnected all the way back to the market potential and data that inform strategy, then there's a problem there in that performance. So the trick is, let's merge all these together. Let's make sure that they are all connected. Andrew, we'll go to the next slide here. Analytics, it should inform better decision making. They should inform better prioritization of what comes first in network planning. Do I grow into a new market, or do I refurbish my existing market? Once that is determined, strategy should inform design. Like I said, build the experience that you want first, and then determine the branch that you need, the format of the branch that you need to deliver that experience. Once those are connected, the true impact and execution comes to life. So this is the main framework that we'll walk through today. Andrew, let's start with analytics, which is, of course, where any good banker would tell you to start, is with the data, but where to be and what to spend.
All right. So we'll talk a little bit now about, like, what's that analytics toolkit look like that we would expect most institutions to make sure they're leveraging. We're gonna have a couple of different frameworks that we think are really important. And for those of you who have perhaps worked with either myself or with Ben, you may have seen some of these phrases on the left or variations on these, or on grow, defend, fix, harvest. But ultimately, what you're trying to do is, in a market in which you operate, and you've got the example of Atlanta here. I want to be clear that this example of Atlanta, those shadings would not be the same for every institution, right? So this is all tailored to your institution, because we're bringing what we describe often as these 4 factors into play. But really, what you're trying to understand is, for the various submarkets within a geography, how do I feel about those relative to my opportunity to win? What's my current branch presence? What's my current branch performance? What's the market opportunity relative to the target segments where I want to win? What does the competition look like? And coming out of that, which of those submarkets would I differentially want to invest in versus which markets would I potentially have the opportunity to take cost out of, right? And so bringing a framework for evaluating each of those submarkets across your entire footprint to have a relative prioritization is really important. Another framework we think about is this kind of concept of network equity, or you could almost think of it as kind of, how am I doing relative to my fair share, right? And so the example on the page here is just thinking about kind of Kansas City, which Kansas City is actually an interesting market. It's a pretty highly fragmented market relative to some others. Which are in many markets across the U.S. are pretty heavily dominated by some of the national players. Here you do see Bank of America being a strong player. but also a couple regional and super regional players kind of out punching their weight. But ultimately understanding relative to my branch share, how much of the deposits within the market am I capturing? And what does that imply for what I need to do, right? I think many of us are familiar with the S curve, right? That's indicated here by the black line. The light blue line is the fair share line, right? Where essentially, if I'm starting from a relatively low branch share, on average, most players are not able to outpunch their weight relative to their branch share, right? There's kind of that natural S curve effect where you ultimately eventually get kind of disproportionate returns to scale. And at larger scales, you're actually typically able to kind of outpunch your weight. But based on where I am relative to that curve, right, is this a situation where I actually probably not need to build more branches ultimately in order to be able to take advantage of scale and eventually start to claim my fair share? Or do I have to say, hey, look, I've built out, right, relative to my branch share, I'm not capturing near enough, and then there might be an opportunity for me to harvest to get myself towards the left to get a little bit more of an efficient position, right? So thinking about what's your kind of gap to fair share, and what does that imply on your willingness and ability to actually build to get to scale, or perhaps take the opportunity to harvest, right? Again, this is done in connection with the four factor, but it is another lens to look through. And the third lens we use is this concept of billboard value. And we think that this is more important than ever before. As the functional needs of the branch continue to decline, people are not using the branch nearly as much for their transactions. They absolutely still are using it for kind of advice and for a majority of the product sales. But because the functional need of the branch is declining, right, what becomes even more and more important is what we would describe as the marketing value of the branch. Is my branch located in places that are going to drive higher levels of unaided awareness and consideration for me to be able to compete and win, right? And so what we've done throughout the country is essentially scored every single block group relative to its kind of quote unquote billboard value. We use a series of inputs in here, essentially looking to where is consumer activity occurring, right? Where are the big box stores? What are the traffic patterns? Essentially, where are people going as part of their live, work, play pattern, so that I make sure that I'm placing my branches in places where they will be seen, where people will be aware that I, as the bank or the credit union, am in the market, I'm open for business, and I want to make sure that you know that I'm here. And so as you evaluate your existing network, thinking about, are there opportunities to either reposition, or if I'm looking for some consolidations, maybe I'm making sure that I'm closing branches that aren't contributing a lot of billboard value, right? But ultimately, I want to get myself into higher visibility nodes. And frankly, with that, I should be able to drive better or higher levels of unaided awareness with fewer branches, right? So if ultimately I need to, over a long period of time, ultimately reduce the number of branches, how do I have the same kind of impact or power punch, if you will, with fewer locations? And it's all about that location. Here's using a different input relative to billboard value, but here we're using mobile geoanalytic data to understand kind of where consumers are going. And what we've essentially done is taken the banks within Kansas City, and we've scored each of their branches relative to how many essentially mobile cell phones are essentially visiting near, essentially conducting commerce, going to the restaurants, going to the CVS, going to the grocery store, drugstore, et cetera. Where are essentially those cell phones going relative to the bank branches? And we broke those into very, very simply into 5 quintiles. And what you see is for those branches that are in that top quintile, right, which is about 26% of the branches in that top quintile, representing that get 73% of the visits here, the cell phone activity near those branches, right? So, and that tells you, like, even a top quintile branch relative to an average, that quintile 3 branch, is 8 times the number of kind of near visits or cell phone activity near, right? So that tells you the extremes of which, how much more kind of billboard value or awareness generation you can get from a highly rated location relative to the poorly located. Now, again, billboard value is not the only thing that I would use when I'm thinking about network planning, but I think is a really, really important input or balance that is is, you know, very, it's a very unique or different input than just looking at the kind of market opportunity and or the branch performance, right? But what is that doing for driving my awareness levels? And ultimately, typically we'll bring these together, and this is an example of evaluating a couple different sites for potential de novo expansion, but I'm bringing in the demographic lens and the four-factor lens to really understand which markets do I believe create kind of higher opportunity. You see some of the demographics, but then also understanding that billboard value, and then you're able to compare and contrast what it would look like to potentially invest in sites at different parts of the submarkets, and what would that potentially yield for me.
Perfect.
All right, Ben.
It's a good toolkit. So the next kind of journey down this chain, we get into the strategy mechanism, and you know, this is where that analytics, that all of those inputs that Andrew just walked through, plus a number of others that frankly we just didn't have time to fit in today, plus a number of others kind of form this, you know, get us into the strategic planning kind of mindset. Now, strategy as a word means a lot of things to a lot of folks. In today's context for this conversation, we want to talk about strategy as stakeholder alignment and execution priorities. So the prioritized actions and tactics to get to what that intent is. You could also talk about value proposition and you know, a number of other things in this bucket. But stakeholder alignment is, I believe, one of the most important kind of outputs that has to come out of the network planning and a strategic planning session. At the end of the day, executives, your board members, your branch managers, all your branch leadership need to agree upon and understand the value of retail to the organization. So Andrew, let's kind of go through here onto this next one, and this I will get on a soapbox a little bit about alignment. It is my belief that the head of retail, or the retail executive, the chief, the client officer, whatever it is, who is responsible for retail, should be building a very strong shared vision for the retail organization. That vision should be so strong that your departmental kind of partners in HR and market and brand and technology and facilities like can't help but get involved. Can't help but bringing this vision, this kind of strategy to life. Retail delivery certainly has to be aligned to the enterprise strategy. There's value that retail has to understand. You know, it is a growth engine. It absolutely can be a deposit growth engine for the org, and it has to be within the brand experience. But man, that strong vision is absolutely crucial and necessary. So I'm going to give you two frameworks. The first framework is a bit to just like, how do I get to this alignment, this value alignment that everyone can agree on. This framework comes from a place that there is, when you ask a consumer, like, hey, what about the retail branch? Like, why do you see that there's value there? And as Andrew has showed earlier in this session, most of the product services that are sold by an institution are coming through that front door, and consumers agree. Hey, if I'm going to change institutions, I'm most likely going to do some research online, but I want to go meet the banker inside the branch. The front door is a value for a consumer. Financial advice, the consumer still marries the branch network to that financial advice that they know they can get. Hey, I got to learn about the features, the products, the loan kind of services, whatever that is that I need for my kind of where I am on my financial journey. Human service for a consumer, when things go wrong, I might call the contact center to make sure that that is going wrong stops going wrong. But when things go real wrong, I'm walking through the door and I want to look somebody in the eye and say, do you have this? Can you solve it for me? And then there's still some basic transaction needs. Like, consumers still connect that, especially our small business customer, which has a tremendous amount of value from a profitability standpoint. transactions are still a piece of the puzzle that need to be solved for. The good news with this is there is direct value in each one of these for your institution. And this is where kind of rubber meets the road. Is your retail branch network an acquisition engine? And yes, it has to be most cases across the board. Acquisition value. There is a cross-sell value. And I mean that in terms of products and services, but also just features and connecting customers to the digital channels and to into contact center potentially. There's a loyalty add that retail provides for your institution. Look, if we can prevent customers from going next door, then there is absolutely value in those actions to do that. And then efficiency. Look, we've been living in this kind of for a while. One small tweak in the retail network can mean a big difference in, like, not from an FTE or reducing branch count, but just making a process easier. I mean, there's, one small tweak can make a big difference. So that's a way to kind of anchor on us aligning value. And then as we move into design, I'm going to jump and we'll go to the next one, Andrew, this gap 2, strategy connected to design. Form follows function. That's what I was talking about when I meant the experience should be embedded and defined first and then build the branch. And then not one size fits all. Every branch isn't created equal. Every market's not created equal. So that same framework, when we apply it to branches at Adrenaline, we talk about branch archetypes. A flagship branch is driven directly for acquisition, for new to bank acquisition, cross line of business potentially. But the experience in that branch, in the processes, the procedures, everything about that location should be designed to grow that market. An advisory archetype is designed to kind of to expand on the financial wellness and the financial literacy of a community. That experience is a little bit different than the flagship. A neighborhood archetype is, look, these are the branches that you just need to stay in the neighborhood, which is why it's called neighborhood locations. You can't get out. And if that portfolio loses 10% of value over time, that is a significant value lost to the organization. And so measuring that is an important piece of the puzzle. And then the convenience or remote assets, those are about efficiency. Let's lower the OpEx as far as we can, but also remain present in the community. A second framework, and to make it really kind of tangible and tactical for you, is this potential versus performance 2x2. Everybody loves a good 2x2, and this one's the best one there is when it comes to network planning. The market potential versus branch performance. And in this example, and we'll walk through kind of what these main quadrants look like. In this example, the fixed underperforming branches, look, you don't have performance, but the potential in the neighborhood or the trade area is super high. In this example here, United Bank, that we heard, people didn't even know they were there. It blended into the big building, kind of got lost in the crowd. Well, some simple renovation here and some good use of lighting and interior kind of branding, makes a big difference for this United Bank location. The next quadrant down is rationalize, and this has been the favorite for so many years here. But look at the example here, this Guarantee Bank example, that in a low performing neighborhood, of course, a low potential neighborhood with kind of low performance relative to the rest of their network. But they didn't want to leave the community completely because that would have kind of run against their value proposition. And so, and quite frankly, you knock the branch down and leave a remote asset that still provides connection from a brand perspective, uplifts the brand in this example, but provides connection of the community to the bank. going to the easiest quadrant to kind of figure out, hey, this is where, hey, we're performing, we're on the right street corner, the potential of the market is still growing, and there's a lot to be got. Maybe you're new into the market, maybe that market continues, that the deposit churn continues to move in. These are places where you can feel comfortable with investing, whether that's the refresh of an existing network, or this is the pocket of where you certainly want to, maybe even grow your presence. And then the last one in the harvest bucket, these are the hardest ones to justify to a CFO. Hey, if it ain't broke, don't fix it, right? You're performing in this market. The potential is maybe stagnant to low to stagnant, and kind of comparative to the rest of the network. Gosh, how are we going to invest in a place that is performing, and why for? This is where that first framework comes into play. There is a loyalty value here. We operate in an annuity business, and the longer we can keep a customer, the more profitable that customer group will be. And so this is just an investment to retain as much of that portfolio as possible. Ultimately, I don't want to walk into a dingy place of business, especially if that place of business is handling my money, my financial, my financial journey. And so refresh, as simple as marketing or adding some self-serve upgrades, absolutely makes sense in this quadrant. All right, Andrew, let's get into the final kind of piece of the chain, the execution area. So this is where the rubber meets the road. The performance is measured.
Yeah, absolutely. I think that, this is really important as there's a need and a desire probably within most financial institutions to invest, right? You've got to make sure that you're doing some performance measurement and management in order to be able to continue to go back and make the business case for more investment, right? And so as soon as you kind of, finish the job and move on, there's a risk of actually, not being able to have the data down the road. And I think this is true both for, I think everyone's really good at probably measuring their success or failure at the de novos, right? They look at the vintages of growth, and they're able to really track that. I think that getting smart also around some of the analytics around what's happened when I've either closed or relocated branches, I think is equally important, right? Is having the measurement in place in order to hit that second point there, measure and evolve, right? How do I get learnings from the actions that I've done to inform future actions? And how do I have the business case to be able to make to the CFO for further investment? And, really just having a really smart set of KPIs, I think, is important. And I think I would highlight here just some of the differences between kind of leading indicators and lagging indicators, is really trying to make sure that you're thinking about, do I have good leading indicators? The lagging ones are typically the ones we have. We've got those in spades, but how do I think about, what are those things that are indicative of future performance, and how can I be kind of more in front of it? And I would think I would use the very first kind of row on here to play that to life, right? Like, we're all measure, how our branches do on new customer checking accounts, right? And we understand, what our net checking account growth is, and we have that in spades, right? But ultimately, what's influencing your ability to acquire new checking accounts is what's happening with my levels of awareness in the marketplace, my levels of consideration, and then what that purchase volume is and what it looks like from a share perspective, right? So how do I get further up into the decision framework? Because if I want new customer checking sales to go up, right, I have very little control within my branch teams on how they can do that. Ultimately, they're only going to be able to execute on the folks that are coming through that front door. So how do I understand what's happening further up the funnel around driving awareness and consideration in order to influence that? And then that comes back to what Ben was saying earlier around it is a community of different stakeholders that are critical in working together to drive performance success, right? And so if I'm not collaborating with marketing as a retail branch leader, I'm really going to be challenged as far as being able to both measure as well as increase performance around that new bank checking kind of flow, if you will. And then I think the other thing is, oh, go ahead, Ben.
Well, I was just going to say, kind of at a network level, Andrew, I heard a new metric that is intriguing to me last week: net checking growth per square foot. You talk about connecting some different stakeholders. It just it's very, very interesting. And here, I mean, this is so, Andrew, you talked kind of at a network level of what to measure, leading leading indicators. I think the reality is we have to be very intentional with how we measure our branch manager, our branch leadership, in a way that they can impact day to day. And that's not rocket science, right? But measure it in a way that is connected to what the branch experience was designed to do. The old adage is, you can't measure a fish by its ability to climb a tree. And you can't measure a branch manager that's in a low potential market by its ability to grow deposits. I mean, either those deposits you've already gotten them, or it's just in a declining market. And so kind of the unfairness of determining a branch value and a branch manager's value to the organization without a scorecard that matches with the experience that's in that branch is a bit unfair. And so I'm encouraging, that same framework, this value framework here, to balance that at a branch level that rolls into a network level. Because once you have branches kind of across your network that are delivering different experiences, supporting each other, that's the powerful network that we're trying to create. And a branch scorecard where a branch manager can absolutely impact the day-to-day target is crucial.
I like this framework, Ben, because I really think it's like, what's the purpose of each individual branch? And not all branches are alike, right? And so how do I make sure that I'm tying the kind of measurement structures and probably the associated incentives back to the purpose for that branch? And the other thing I really like on the page too is the use of peer benchmarking too, right? So not just looking at my historical performance and tweaking it up a couple percentage points here and there, but really understanding two things: one, market opportunity. How am I doing? How are my goals relative to the opportunity that's available to me? And then two, how do I essentially assess that relative to peers who are in the same situation or same market opportunity, and how do I connect some of those pieces together? I think, which brings us to our kind of key takeaways, Ben. So I'll give you this one to hit the kind of key conclusions or key observations.
Perfect. A lot of good takeaways here, Andrew. I appreciate you. I learned something just doing these with you. I would say, look, understand what that chain of disconnect, and make it not a chain of disconnect, but just a process that you walk through network planning. You have to start with analytics. You have to get alignment on what the strategy is. And within that strategy, understand the value of retail. Let those two things then inform design. Again, you don't start with colors and aesthetics, but you start with the experience that you want to create, and then let that inform kind of the format of the branch. And then to Andrew's point, measure your performance against peers. If you're not doing that, then that's absolutely a place to go. The second kind of key conclusion is what I would say is all markets are not created equal, and all branches are not created equal. So a peanut butter spread goaling structure or a peanut butter spread investment structure is not enough when you're talking about optimizing for growth. So those are the two that jump off the page to me. Andrew, how about you?
Yeah, I think that's great. I really like the point around, not all markets, not all branches are the same. And I'm going to echo that one. It is tough to make trade-off decisions. No bank, no financial institution ever has enough to be able to spend the way they would like to. And so these are really tough trade-off decisions of where I'm willing to invest and where I'm willing either to not invest or actually take cost out. And how do I kind of trade those off against each other, ultimately driving towards aggregate kind of customer and balanced growth for the institution, right? And then sometimes that might mean I'm going to sacrifice growth in one market because I can get better growth with that same dollar of investment, or redeployment of that dollar investment elsewhere. And so making sure that you're really cognizant of those trade-offs. I think that's awfully hard, especially in institutions that have kind of what I'll call a federated model, where there's a lot of kind of powerful decision makers, either a regional president or market president or whatever the role might be, who are all kind of fighting for investment. And often that results in a peanut butter spread of everybody gets some. And so there's really hard, tough kind of trade-off decisions never get made. And so kind of helping to drive your institution to make those trade-off decisions, I think, is really critical. I think with that, we're opened up for questions. So I think you should be, I think your all screens is a little different than ours, but I think there's a place where you can type in a question and we'd be happy to answer. I do have one here that someone had typed in earlier. I'm going to go ahead and take it, and then maybe there's another one here that I might give to Ben. But one of the questions is, if the world is eventually moving to digital, how can I justify building branches that have a 10, 30-year lifespan? I think it's a great question, and it's a trade-off decision that every bank and every institution is making. I think one thing to think about it is, don't think about it as that individual branch, right? Only that individual branch, right? The question is, you need to have a market strategy, market by market. And if you think about it, I think we're all going to agree we're still going to need branches in 20 years, right? So the question is the investment in this branch something that is a good 20-year decision? It doesn't mean that everything around it is going to be unchanged, right? So if I'm constantly working towards a better end state, I can invest in a branch there, knowing that maybe there's an adjacent branch down the road where I'm really happy with that branch today, but in 5 years or 10 years, that might be an opportunity for me to actually close that one, with the new branch that I'm building being the survivor, right? So don't think about decisions as one-off individual ones, but be thinking about the network that you're building, and ultimately are the decisions I'm making now increasing the permanence, if you will, of that individual decision, knowing that I have other optionality around it. And do I think that institutions probably need fewer branches in 10 to 30 years? Absolutely. However, there's a glide path to get there, and each step you should be doing in the context of that glide path. All right, Ben, I'm going to hit you up with one.
Just real, let me just real quick.
Oh, yeah, go ahead.
I would also say, if we're asking that question, is it branch versus digital? One, a customer does not consider channels. Like, that's not a thing. They just think of bank on the street, on the street corner or on my phone. If you're asking that question, I would also pose that there is a value, that your value proposition to this date has been built around your people or your differentiator. Potentially, right? I haven't met a banker that hasn't said, yeah, our people are really good and they are the differentiator. Well, for the people to be a very good differentiator, they need somewhere to work out of, and having that branch on the corner is absolutely a kind of a critical piece of the puzzle. Like you said, Andrew, 10, 30 years from now, who knows what that looks like? But certainly for right now, it is a big part of many institutions' value proposition.
All right, Ben, I think you hit this one a little bit earlier, but I'll give you one more chance to do a slam dunk on it. Is, why do I need different branch formats?
Yeah, it goes back to, if you don't take anything away from this, say every market is not created equal. And so if you've got one branch that is in a market, it goes back to the 2x2. In a market that performance is high, potential is low, that branch experience fundamentally has to be different. that the bankers are providing to that customer set. And it's also pointed at a different value add to the organization. Retaining those deposits are still very necessary, versus a branch down the street that's in the the new hip place to be, the new retail development coming into town, the all the cool new places to eat. Well, that branch needs to grow. And so when you have the combination of the two, you have an experience that's designed to retain deposits, and an experience designed to go attract deposits and to be in the community. Those are two very different things that absolutely dovetail together. And at a network perspective, you're driving value on both sides of the equation, retaining what you have and then growing what you have. In that example, those two locations can be in the same trade area, even with different experiences. So that's what I would say. Not every branch is created equal, because not every market is created equal. We don't need to have peanut butter spread experiences or value propositions in the branches.
So one other question, I'll take a whack at it. What differentiates banks that are able to successfully grow de novos versus those that are not, right? So I think, look, this is a big challenge. Even for the names that the brands that we were showing earlier, which are some very large institutions who have some pretty big commitments on what they're willing to invest in branches in the upcoming years, right? I ultimately think there are a couple different dimensions that are really important. One is the integration of marketing and branching, right? Is thinking about how, those are both investment levers that need to work together, right? And so if I'm building branches, if I'm not willing to put the marketing spend behind the successful kind of initial start of that branch, then I should probably think twice. If the incremental marketing spend associated with that is not part of the initial business case, it should be. So thinking about those together, right? What am I going to do differently to support that branch in order to get breakout growth? If the company is going to be spending a couple of $1 million investing in that, like, what are we willing to spend in addition to help increase the likelihood of success of that, right? And how do we build that into the business case? I think the other thing to think about is branches just cannot be consumer only, right? I think that the branch is a representation of the bank to the community, and I think we need to be thinking about how does that branch support all different lines of business. It doesn't mean I have to have all lines of business necessarily sitting in that branch, right? I don't necessarily have to have my commercial banker come from downtown to go sit in that branch, but how is that branch actually representing and showing up in the community to influence the decision makers across all those lines of business, whether that's wealthy or affluent consumers, whether that's business owners, and whether that is, kind of everyday consumers or smaller businesses. And, also kind of combined with that is what sales force do I need, right? So based on where I've located that branch and the market opportunities available, do I need certain types of specialists, either wealth bankers or business bankers, as part of the branch complement? I think what we've seen is some of the brands who have had more successful de novo growth trajectories have really been bringing kind of all lines of business together in driving that growth. And so if you try to do everything on the back of the consumer only, you're going to be really challenged to be able to hit those growth curves.
Those retail bankers out there high-fiving you right now, because they've had experiences where they're asked to fund the build of this new branch, but then also grow the deposits only retail. So yeah, Andrew, I could not agree more. It goes back to me for having a very strong business vision, a very strong vision that your line of business partners, your support partners, like, can't help but want to be a part of. I mean, you mentioned marketing, you mentioned HR in your response to hiring the specialist. You answered kind of the line of business growth. I mean, think how powerful it is if your retail head looks at the small business line of business lead and says, hey, I need $50 million in deposits and XYZ, new small business customers. also your market, this market that we're growing in, has that to give. So I need 50 million from you for private wealth. I need 125 million from you. Retail bankers, I need 75 million from you. When you collect all those things together, now that branch looks very different from a performance perspective, you know, on a 3-year run or a 5-year run. And you know, you've made a good decision to build that location, that new location. So I think it all starts with having a very strong vision and a very strong measurement system for each one of those different line of business partners. Do we have time for one more, or are we at, what do we think? I think that
we don't have any more questions coming in the queue there. So
yeah, there's one, we're very much related to what we just talked about. If I can't close any branches to help fund investments in de novo, what am I supposed to do? Well, I don't know. I guess you're not doing de novo. No, that's I think it goes back to like finding a different way to fund it, finding support from different line of business partners to fund that de novo, and getting very comfortable with the market potential that's in that new place that you want to build.
Yeah, I think I would challenge the initial assumption that I can't close any branches, right? So like, I don't think you should close branches just because you have to, but I think if you can evaluate what would be the financial impact of closing one branch, and if I were to take the dollars and redeploy that into a de novo elsewhere, right? Could I generate enough growth to help pay for any of the incremental operating expense that would require to build a de novo, right? Because I'm going to create some savings on one side. I am going to lose some customers. I'm going to forego some future sales, but I'm not. A lot of that book I'd probably be able to keep, probably be able to retain and service out of an adjacent branch, right? And then if I can redeploy some of that investment dollars towards a de novo that allow me to drive growth. If I can't make that trade-off work, if I can't build that business case, then I probably don't go do the de novo. But making sure you're thinking about the different dimensions of how you could fund it and what those trade-offs might look like, and see if you could get there. You need to be bringing all those pieces to the puzzle together, anyways.
Andrew, I say we close up shop. It's been a pleasure kind of chatting, talking shop with you again for an hour. I think we could probably keep going for another afternoon or so, but thank you to everyone who showed up to listen.
And I think, as Megan highlighted at the top, you guys will all receive a link, I think, to both the recording and the presentation. And if you have follow-up questions, do not hesitate to hit Ben or myself up. Make sure that a follow-up link, but it's pretty easy to find us on LinkedIn if you need to track us down. But it's andrew.hovet@curinos.com and ben.hopper at adrenaline.com. So it ain't too hard to figure out. So thanks a lot to everybody for joining us today.
Thanks, everybody.